Okay, so hello and welcome to today's webinar on fire and underinsurance. Thank you for joining us. This session is being recorded, and as a reminder, all cameras and microphones are turned off for the duration of the presentation. We're really pleased to have you with us as we explore some of the key challenges and considerations around fire risk and the critical issue of underinsurance. These topics are more relevant than ever, and today's session is designed to provide you with valuable insights and practical guidance. We're joined by three fantastic speakers, Stuart Powell, Stacey Kennedy, and Jack Taylor. Each will bring their own expertise and perspective to the discussion. The session will run for approximately 45 minutes, and we'll wrap up with a Q&A at the end. If you do have any questions during the session, please feel free to submit them via the chat or the Q&A function, and we'll do our best to cover as many as possible. So let's get started, and then I'll hand over to our first speaker, Stuart Powell.
Good morning, everybody. My name is Stuart Powell, and together with my colleague Stacey Kennedy, who will speak in a short while, we're part of the Zurich Large and Complex Property Claims team. I'm just going to touch on who we are, what we do, and a few emerging trends, and then we'll get into the nitty-gritty of underinsurance. So the Large and Complex Property Claims team are a bunch of individuals. There are 12 of us under the leadership of Megan Dunford. And we will oversee property claims from £100,000 and upwards, with no limit on that. As you can see from the slide, our team is split into three particular areas based upon claim value. And whilst we will always support each other, we have a huge amount of experience which allows us to deal with those claims. In fact, across the team, we have over 335 years worth of experience in the insurance industry, and even the most inexperienced of our team has over 14 years. So as you can see, we're well versed in dealing with these type of matters. I just wanted to touch on a few of the emerging trends that we're seeing, and I'm sure it won't come as any surprise to people on this webinar that lithium-ion batteries and photovoltaic panels, or solar panels as they're probably better known, are the main trends that we're seeing. Lithium batteries are prevalent in our lives. They're in our phones, our laptops, toys, tools. They're pretty much everywhere. In 2024, e-bikes and e-scooters represented 40% of the fires that were reported. It's a growing trend. About 65% of consumer battery fires are caused by improper charging practices, and a further 20% of the fires are caused by incorrect and improper disposal and recycling. So they represent a significant challenge. And with temperatures exceeding 5,000 degrees Fahrenheit in lithium battery fires, the amount of damage that they can cause is significant. On the solar panels, the number of properties where these are being installed across the country continues to grow. There's been a 65% increase in fires reported between 2021 and 2024. Causation for these fires is mostly due to installation or poor installation, incorrect wiring, faulty wiring, incorrect component failures. So it tends to be more of a workmanship issue as opposed to a design issue. Both of these topics are huge areas of interest and could be subject to their own separate presentations. So I won't spend any more time on that, but what I will do is now move on to the purpose of today's call, which is underinsurance. So I'm going to start off with a case study about a major loss retail fire. So our insured on this occasion is a large family-owned independent shoe retailer with over 30 years experience in the shoe industry. So they operate 3 stores, 2 of which are in the same town and are in fact interconnected buildings. And this is where the fire actually occurred. The turnover at the affected premises was approximately £1.9 million. So we can see it's a significant business, and it has strong local community ties as well. So the fire broke out at 6 a.m. on a Friday morning on the first floor of one of the buildings. It spread very rapidly, engulfing stock, contents, as well as the roof structure, and it spread laterally from that the fire started in through to the adjoining interconnected building. So the emergency response was really prompt, but that didn't stop the damage being extensive. The premises were actually rendered unoccupiable, and the incident received wide media coverage. You can see from this slide that the extent of the damage was significant. The roof had actually collapsed, all of the interiors were charred, and there was a total loss of the inventory. So all of the shoes and the retail fixtures and fittings were destroyed. The fire affected both buildings, which compounded the damage, as well as the recovery costs. There was presence of asbestos, which added to the complexity and added to the cost of the debris removal because of the need for specialist expert removal. And what this does is it highlights the need for insurance policies to reflect what might be the worst case scenario for a customer. So when it comes to how the cover was placed, each premises had its own separate buildings, stock, contents and business interruption sums insured, albeit they were all insured under the same composite policy. Cover for the stock, contents and the business interruption was adequate. However, the sum insured for one of the 2 buildings was not. In fact, it only represented 54% of the value at risk. The insured had fallen into a fairly common mistake in basing the sum insured upon the purchase price of the property rather than the reinstatement cost. As a result of that, there's likely to be a £70,000 shortfall in the building settlement for that building. So what are the consequences of that? So underinsurance has led to a reduced claims payout for the buildings. And as I said, that's in the region of about £70,000. Whilst the insured has continued trading from temporarily rented premises, the amount of time taken in arranging demolition and reinstatement tenders has meant that the reinstatement won't commence and won't complete before the end of the business interruption indemnity period, which means that once the insurance policy stops funding any shortfall in income as a result of the fire, the insured will need to find the funds to complete the rebuild. So it puts financial strain on the business. That might cause delays in obtaining stock, reduced stocks or scope of stock that they can stock. That's a strange phrase, that they can include in their stores. And that erodes customer trust, unfortunately. That inevitably will lead to questions about the advice that they may have been provided. And whilst it's not necessarily anybody's fault, they will look at their brokers if they've been involved in the placement of the business. So it's something that communication between the customer and the broker is going to be key. And on that note, I'm now going to pass you over to my colleague Stacey to talk about a separate case.
Thank you, Stuart. Okay, so in this brief overview of a case study, we're examining another underinsurance case managed by Zurich. This example highlights the complexities of aligning insurance policy limits with the actual rebuild costs. I'm going to focus purely on the building in this instance. Our focus during this loss was to ensure fairness, transparency, and best practice in claim settlement. In this incident, the sum insured was set at 9.5 million. It was fixed with no automatic adjustment for inflation or rising costs since the last renewal. This cap limited the maximum payout regardless of actual costs incurred. Following the incident, the property was reassessed and the actual value of risk was identified at 13.3 million. Underinsurance was identified early on in the loss, with the expectation that the policy would cover only 72 to 75% of total costs. Once all financials were established, as a result of the average clause within the policy, the claim payout was proportionally reduced, resulting in an insurer contribution of around 72.83%. So with a total reinstatement of about £2.1 million and Zurich contributing approximately £1.5 million, this created a funding gap of about £567,000. Just to put it into perspective. In terms of the adjustment, one of the critical factors in this case was the assessment of professional fees as part of the overall rebuild cost. The original reinstatement cost assessment included a 10% allowance for professional fees. However, this was found to be significantly below market norms, especially considering the complexity and scale of the project. Actual professional fees incurred were just over 21%, reflecting the real costs of managing and delivering a project of this magnitude. After collaborative discussions, Zurich agreed to apply a 19% professional fee. This adjustment was made to reflect economies of scale, meaning that for a full site rebuild, certain efficiencies could be achieved, resulting in lower proportional costs than if each building were rebuilt separately. The 19% figure used is in line with industry standards for large-scale projects and ensures both fairness and consistency for all parties involved. Importantly, as this slide demonstrates, applying the adjusted fee resulted in an improved settlement for the insured. The final insurer contribution increased to 72.83% of the project costs compared to an earlier figure of 71.71%. This means the customer received a higher payout by applying a 19% professional fee rather than the actual fees of over 21%. This example demonstrates Zurich's commitment to transparency and fairness, ensuring the insured received the best possible outcome under the terms of the policy. In terms of the claim journey, when we're talking about lessons learned specifically, managing these types of losses can be challenging, especially when the value of the loss is significant. Clear communication is essential. From early discussions regarding the identification and anticipated level of underinsurance to a collaborative approach throughout the claim to ensure we're offering our full support, through to ensuring we are using market-aligned assessments for fairness and consistency is key. In this situation, our customer finds themselves in a position where they must source additional funding for the shortfall. I mentioned at the beginning of this case study that the sum insured was fixed with no automatic adjustment for inflation or rising costs since the last renewal, and that cap limited the maximum payout, regardless of actual costs incurred. This loss demonstrates the requirement for accurate valuation and comprehensive insurance coverage. If nothing else, I strongly urge that you take away the importance of regularly reviewing and updating reinstatement cost assessments and sum insured values to reflect current costs. Ensure all associated costs like VAT, professional fees are included and market aligned. Thank you very much for listening. I'll now hand over to Jack for the next part of the presentation.
Hi guys, I'm Jack. I lead the RCA team over at Zurich Resilient Solutions, and today I'm just going to talk you through a little bit about underinsurance, as the other guys have kindly done, and a little bit about what we can do to sort of help mitigate that too. So, very brief introduction about ZRS in general. So ZRS, if you don't know, really big sort of risk engineering consultancy practice who operates across the globe. I won't bore you with the statistics, but we're quite a big team. Some of the services we provide: building valuations, or otherwise known as reinstatement cost assessments, property risk programs, Zurich Insight, training consultancy, fixed fire protection services, and escape water. So, getting into the nitty-gritty of it now. So underinsurance. So underinsurance, as we all know, is when the insured value of your property is less than the actual cost it takes to rebuild it or replace it. And in other words, your insurance policy isn't adequate enough in terms of the cover that is required. Why does it matter? It matters really, because in the event of underinsurance, the insurer has the opportunity to apply the average clause. Applying the average clause is obviously never a nice thing to do, but sometimes is necessary, and it can mean that you are liable for shortfall in the event of a claim. Some of the implications of underinsurance means reduce claims payouts, financial hardship on the customers, delays in recovery, and legal and reputational risks. So the average clause. So what is the average clause? So here is a little bit of a scenario to take you through how the average clause would actually work. So say that building to the left has a total rebuild value of £5 million. The sum insured is set at 2.5 million, and the damage from a fire is £1 million. So that means that in the event of the claim, the payout would only be £500,000, so half of the damage caused, because the property was only insured for half of the amount that it was supposed to. So yeah, it can be really quite expensive for customers to have to make up that shortfall in the event of a claim. So mitigating underinsurance and making sure that average clause is removed from policy documents can be really beneficial to all. So reasons for underinsurance. So we've gone through a few already, and the list can be as long as we like it to be. To be honest, there can be lots of points of failure from all different aspects, but I suppose that the main ones would be outdated valuations. So making sure your values are up to date and the proper assessments have been completed. So that means having a sort of a formal RCA reinstatement cost assessment carried out every sort of 3 to 5 years. The RCS does recommend a fresh assessment every 3 years with annual index linking in between. It is a recommendation. It's not uncommon for those assessments to sort of prolong to the 5-year mark, but I really wouldn't recommend it go on any longer than that, because changes in build costs, as we know, it has been a little bit unpredictable over the last few years. It can either compound the index linking that you're applying, cause overinsurance, or worst case, the figures are underinsured because they don't quite match the current building costs. Another reason is renovations or improvements. So whenever there's any changes to the property, if you're changing a tap, I wouldn't worry about it. If you're making any major changes to the building, any extensions, partial demolitions, refurbishments, etc., it's really important to have your reinstatement cost assessment up to date and reassessed, because it will have quite a critical impact on your declared values and your sums insured. Inflation, so the index linking that I have been talking about, sometimes that isn't applied, or sometimes it's not applied adequately enough. So if that is missed, then I suppose the further on you proceed across the years, the more and more you will be underinsured. So it's really important that those index linking figures are sort of up to date. I suppose rising construction costs, so increased costs in labour, materials, professional fees, sort of frequently overlooked during the reinstatement valuation. So it's really important that you're talking to people who really understand the costs associated with that and can point you in the right direction. Confusing market value of rebuild costs. So I think we have touched on it earlier on in this call, but it's something that we see quite a lot. Applying market value for your sums insured, it really isn't a good idea. More often than not, because if you live in the south of the country, you could find that you might be overinsured in some cases, and if you live in the north of the country, you could find that you're significantly underinsured in a lot of cases. So it's really important that you don't use the market value or the purchase price of a property to apply your insurance. Omission of assets. So something that we see quite a lot is, I suppose, not understanding the property owner's insuring responsibility. So that's something that we work really hard to do as a team, is actually understand what is yours and what is not. So it's, I suppose, sitting down and working out where's the boundary line, what's yours, what's not yours. If you are a commercial owner and you lease the building, what in the building is yours? If you've got some warehouses, are the mezzanines yours, or are they the tenants? And really sitting down and understanding what it is that is your insurance responsibility, so that we can adequately calculate and make sure that you're covered. So one of the ways you can help mitigate any underinsurance and make sure that you have the appropriate levels of cover is to obtain a reinstatement cost assessment. So if you don't know already, what is a reinstatement cost assessment? Well, it's a professional evaluation of the amount it would cost to completely rebuild your property on a like-for-like basis, obviously following the RCS guidance notes closely. So typically what's included within an RCA, so that will include your build costs, your external works, your professional fees, your demolition and debris removal fees, any cladding and building regulation fees, as well as compliance with the latest sort of laws or statutory regulations, if there are any changes needed to be made to the property. So when should you have an RCA done? So I suppose the official advice is ideally every 3 to 5 years you should have an RCA done, with those annual index link updates in between. If you also haven't reviewed your insurance for several years, after any major renovations, extensions or upgrades to your property, and I suppose, yeah, ideally just keep them on top of them to make sure that they're always in line with where they should be. And I suppose why should you get an RCA done? So prevent under and over insurance. Underinsurance is obviously a massive issue across the entire market at the moment, but over insurance can be an issue as much as we don't want you guys to be underinsured. I'm sure you don't want to be overpaying either. So having an RCA done really makes sure that you are sort of smack bang where you need to be in terms of your premiums and your insured amounts. So having an RCA done makes sure that your sums insured are truly reflective of current rebuild costs. It gives you the peace of mind, and also it helps you meet those RCS recommendations and insurer requirements. So RCAs, I suppose they're great to get. it is quite a saturated market. There are a lot of providers out there that don't provide good quality RCAs. So I suppose this slide is just to say not all RCAs are good RCAs, and you do very much get what you pay for in this market, unfortunately. If you go for a cheap RCA, it is going to be poor quality, whereas if you go for sort of middle of the range or more expensive RCA, you are going to get a much better representation on what your rebuild costs are there. So some of the reasons why they're for RCAs. So there's quite a lot of use of, I suppose, what we call intelligent AI nowadays. But it's far too heavily relied upon to set those rebuild costs and those declared values. Inadequate rates are used, so that means, I suppose, relying too much on average rates. Anybody can go and get a rough area of a building and a rough rate based on the occupancy type and times them together and ship them off. That's something I'm sure we can all do. But what is actually appropriate with an RCA is building it up on an elemental basis and pricing things appropriately as they should be, and not just relying on that average data, because it is just average data and it doesn't always cover you. every building is different. They are similar, but they are also different. So it's the separation and expertise is definitely needed. So yeah, little to no human technical knowledge applied to those assessments. I've seen ones with missing floors, and it was on a 3-story building, so I don't really know how they managed it, to be honest. Whole buildings and units missed. So this could be if you have a large school site, there could be sports halls missed off of it, or sort of outbuildings, storage buildings that just haven't been considered as part of the assessment. So I suppose going back to really understanding your insurance responsibility. Rates not tailored to the property. So a lot of the average rates that you can see online are based off of, I suppose, predominantly new build properties. But going back to the example of a school, if you have a school that was built between sort of 1900 and 1940, the average rates that you see today that are published online won't be appropriate for that school because the construction methods are totally different. Obviously, if asbestos was used during the construction process, you wouldn't then price to sort of put that back on a like-for-like basis, but ultimately the wider corridors and larger floor-to-ceiling heights would all still need to be accounted for and wouldn't form part of that average rate that we're all so familiar with. So it's really important that a professional assessment is done, so they can come in and they can assess the cost of the foundations, the superstructure, the roof, the elevations, and then they can then build up all of the various things like building services, number of toilets on an elemental basis to give you a really accurate view of where your declared values should be. And I suppose all of the above from the poor RCA section lead into incorrect declared values and potentially underinsurance. I spoke a little bit about it in that one, but I suppose an accurate RCA would be a comprehensive property inspection, sort of boots on the ground approach, accurate measurement and area calculation, detailed construction analysis, professional fees, DEMS and planning and building regulation fees are appropriately considered and priced for, allowance for inflation, so those index linking assessments, specific region and location factors, preliminary fee considerations, tax and VAT considerations, and I suppose anything and everything that we see in the building. So calculating accurate RCAs is a process which takes many steps, not just a couple, and does require industry expertise. It isn't just the estimated area, average rate equals declared value. If it was that easy, I'm sure we'd all be doing it. So an example of poor RCAs. So we were instructed this year to carry out a handful of RCAs for a particular customer. Some of these RCAs were done in-house, I suppose, with that very basic formula that I've just shared with you, and some of them were done externally with a cheaper provider. There were some questions around the sums insured. The underwriters weren't quite happy with them, so they asked us to take a look at a handful of them, and you can see on the right hand side how far out some of those figures really are from where they should be. Some of these buildings were listed, some of them are high value, some of them are lower value, but you can see that we reduced one by 66% and increased others by 250%. And I suppose the main reasons for this is, I suppose, poor methodology and understanding when completing the RCA. So not understanding what is to be insured and what is not to be insured, but also making sure that all of your calculations are correct. So the floor area is accurate and correct, and the rates that you use are accurate and correct, based on some of the information. So I suppose some of the reverse engineering of the calculations that we saw prior to completing the assessments, you could, you really could knock up some of those buildings for the cost of a garden shed, which obviously it isn't true. So it's really important to get some professional advice. A little bit about sort of market conditions and forecasts now. So yeah, it's been a pretty turbulent sort of 5 to 7 years, especially since COVID. We've seen some really large price increases. Over the next 5 years, it's supposed to steady out a little bit, and we are looking at, I suppose, more normal growth of 15% between now and 2030. TPI, so tender price index, over last year has gone up by 2.5%. Labour costs have gone up 7%. They've continued to rise. The rise has slowed a little bit in previous years, but they are continuing to rise steadily. And material costs, are slightly more stable at 0.5% growth. Reason why they're slightly more stable is because output and demand isn't quite there at the minute, but we are looking for that to pick up in 2026. Some of the key market drivers and the risks are the labour shortages and the costs of labour increasing, regulatory costs, so increase in NI and changes in NI and building regulation. Material costs and contractors' margins as well. So just some key highlights. So figures, I suppose, like this are sort of bounded about quite a lot across LinkedIn and various marketing information, etc. But the figures are never flattering, even if they're not the same. 76% of UK buildings are underinsured. 10% of small organisations wouldn't survive a £10,000 claim. There's over almost £1.2 billion of underinsurance, and as of September 2024, the index has increased by 42.7% from January in 2020. So if you haven't had any formal RCAs completed since before 2020, there is a chance that you could be significantly underinsured. How we can help, who we can help. So we can help by providing some RCAs, and I suppose who we can help extends to everybody. So whether you're a commercial investor, occupied developer, or specialist customer, or you are more municipal, SME, property owners, we can help anyone and everyone. And this is a little bit about what we do. So we provide the on-site assessments, the portfolio health checks, to give you a bit of an indication where I suppose there might be needed some targeted work and some desktop RCAs for those properties that are suitable. Cheers, guys.
Thanks, Jack. Just wanted to point out that we have the QR code here for any feedback whilst we're doing the questions and answers. I'm going to pass over to Stacey for those.
Thanks, Hayley. We've got a couple of questions in here. I will pick the ones that we definitely can answer first. And then there's others that we may need to take away because there's considerations like the underwriting team that would be responsible for things like pricing and premium refunds. And we'd need to take that offline and come back to you on those points. So with that, Joanne Sissons has asked what our position would be if a customer has a very large property portfolio and in the event of a claim, it is found that the property that has been damaged is underinsured, but the overall for the full portfolio sum insured is adequate. So I think I'll pass that one to Stuart.
Thanks, Stacey. It's a good question and something that we do see quite often. I think the starting point always comes down to what does the policy wording say? And if the cover is applicable on a per site basis or per property basis, then you would look to apply the terms and conditions applicable to that particular property. And if that was underinsured, then that would be the terms that would be applicable. I think the question says if it's a large portfolio, but overall that portfolio is adequate. And I think my question would be, if it is a large portfolio, how would you evidence that the overall sum insured was adequate, as opposed to just the one premises being inadequate? So it would be a discussion to be had. But normally where you have large portfolios of premises, you get the benefit of that wider sum insured. But again, it comes down to the terms and conditions for each individual policy. So I hope that helps.
Thank you, Stuart. And Jack, I think I'll point the next question at you. So Stuart Mosley has asked, if you employ a RICS surveyor to do your valuations, does that necessarily mean that they will have done a proper RCA?
You'd hope so, but I suppose it is a saturated market for RCAs, and don't feel please feel like you can sort of ask questions around the methodologies used, because they're not always accurate, they're not always appropriate. A lot of people will have a slapdash approach. You do get what you pay for, unfortunately. Having RCS qualifications will mean that you have the ability to complete a really good quality job on RCAs. It doesn't always mean that that individual will. Although it shouldn't be like that, I will say that.
Okay, and I think we've probably got time for one more. So Joanne Sissons has asked about the VAT that I mentioned in my case study, and I will say, Jo, I can see that in your question you've explained that the council are VAT exempt, and for that reason you've always been advised not to include VAT in the reinstatement calculations. That's absolutely fine if you're VAT exempt. However, there are situations where we find, for example, there's only partial VAT exemption depending on the nature of your portfolio or the properties. And in instances such as that, you need to really make sure that if you're VAT exempt, you're entirely VAT exempt. But if there are areas or properties that are only partially VAT exempt, then you need to be accounting for that within your consideration for the sum insured. I hope that answers that question. Somebody has asked, oh, is it Joanne as well? How much is it for ZM to do the reinstatement exercise? I'm not sure I entirely understand the question. Would you be willing to expand a little bit on that, Joanne? If you're able to.
I might be able to jump in here. I think Joanne's asking how much do the RCAs cost. It varies really.
RCAs.
It depends on the properties, it depends on locations, all that sort of stuff. If you are interested in finding out a little bit more about how we can help, please drop me an email. I'm sure my email will go out in the email address will go out in a follow-up email shortly. But yeah, please feel free to get in touch. I'm more than happy to help.
Okay. Hayley, we've got 3 minutes left. I can either ask another question or we can wrap up and respond to the rest. If you want to close.
Yeah, no, that's fine. It's very quick
Okay.
close from me. Just really to say thank you to everybody for joining. We hope you found this session interesting and useful. We'll be sending out the recording. If you could take a minute to fill out the feedback via the QR code, would really appreciate it. Yeah, and take care, and we hope to see you on the next one. Thank you to all the speakers.